So following the sell-off we saw sort of August, October of last year, we have turned a bit more constructive on risk overall, and that has been definitely helped by the appearance of a pivot from the Fed, right? No more sort of higher for longer. Instead, sort of the market's been pricing in cuts, and the Fed has, to some extent, has been blessing those cuts. So we think that's a constructive stance for risk-taking somewhat. But on the medium term, our view is still that of a mild recession. As a result, risk on for the short to medium term, but beyond that, we're going to be taking more of a sort of cautious stance on risk.
Right. And what does a mild recession in the U.S. mean for Asia?
First of all, what does a mild recession mean for the U.S. and before that, before even sort of touching what that means for Asia? Mild recession probably means unemployment rate in the U.S. increasing by 1 or 2 percentage points, which probably means sort of spending comes down. It probably means consumer spending, which has been the big heavyweight lifting the U.S. economy. That potentially sort of starts rolling over. What does that mean for Asia? On the one hand, on the trade front, on the trade channel. It could mean eventually, sort of second half of the year, probably sort of weaker demand coming from the US. But on the other hand, if we think of what's been a big headwind for Asian markets, for Chinese markets, has been very high dollar and also very high treasury yields. So as and when we see subsiding of those two, eventually that could mean good news for Asian markets, especially on the multiples front.
Mandy?
Well, both of them have been subsiding. The US dollar has definitely come well down from its peaks of last year. Yields have also come down from their peaks. Do you expect them to continue to move down?
I think things have rallied sort of too strong, too fast, to be honest. We did hold more duration in portfolios and more credit in portfolios in Q4, but we actually have been reducing our exposure to duration and credit. Now, why is that? We have to start thinking, why has the Fed done the apparent pivot? Why is that? On the one hand, one could argue that it's because if we look at inflation, if we look at sequential inflation on a month-on-month basis, or if you annualize the past 3 months, inflation does seem to be going closer to that sort of 2% level. If that really is what's happening and there's been no damage, essentially the inflation genie has been put back on the bottle without any damage, that's definitely fantastic news.